Hi everyone, welcome back. In this session, we're going to try and understand the core reason as to why we are required to prepare consolidated financial statements. Now, before we actually enter into the consolidated financial statements, let's take an example of a head office and a branch. Let us say there is an entity which has got an head office in, let's say, New Delhi, and it's got a branch in Mumbai. All right, it's got a head office in New Delhi and a branch in Mumbai. Although the books of accounts for the head office and the books of accounts for the branch may actually be separate. All right, the head office might prepare its own trial balance, the branch might prepare its own trial balance, but at the end of the year, when I'm issuing the financial statements to shareholders, I do not issue two sets of financial statements. I do not tell the shareholders that this is the financial statements of the head office, this is the financial statements of the branch. I do not do that. I produce one set of financial statements which gives the combined results of the entity as a whole. All right, I will produce one set of financial statements which will include the profit and loss for the entity as a whole. It will also include the balance sheet, which will include the assets of the entity as a whole, which means it will include assets of the head office plus the assets of the branch. Similarly, it will also include the assets and liabilities of both the head office and the branch. All right. In case of a head office and branch, although the books of accounts might be separate, when we are issuing the financial statements to the shareholders, we are producing only one set of financial statements to the shareholders. Now let's take a look at parent subsidiary. The same scenario, let us say I've got a parent in New Delhi and I've got a subsidiary company in Mumbai. If you actually give it a thought, in substance, head office and branch are exactly the same as parent and subsidiary. Now, why do I say that? The reason is the head office, just like how the head office controls the decisions of a branch, the parent also controls the decisions of a subsidiary. All right. A branch may be given some level of autonomy. All right, the branch may have a separate branch manager, but at the end of the day, the branch is required to adhere to the principles and policies that the head office has prepared. The branch manager is accountable to the people at head office. In exactly the same way, subsidiary may also have some level of autonomy. The subsidiary may have its own management, it may have its own board of directors, but a subsidiary is required to adhere to the policies and procedures of the parent entity. The parent entity has got the control to direct the subsidiary to follow certain procedures and policies. Now, in both the head office and in the case of parent subsidiary relationship, the head office might not be actually engaged in the day-to-day activities. The head office may not tell the branch on a daily basis whom to sell goods to or whom to procure goods from. Similarly, the parent may also not be involved with the subsidiary in its day-to-day activities, but yet at a broad level, both the branch and the subsidiary are required to adhere to the policies and procedures that have actually been set up by the head office and the parent respectively. All right, so the head office controls the branch exactly in the same way the parent also controls the subsidiary. All right, when we are issuing one set of financial statements in case of a head office and branch, applying the same principle, we are required to issue one set of financial statements for the parent and the subsidiary. Hereby, I will refer to parent and the subsidiary called as the group. Together, they are called as the group. All right. Just like how head office and branch together are called as entity, here parent and subsidiary are going to be called as a group. The parent and the subsidiary are required to produce one financial statements for the group as a whole. That financial statements should show the profit and loss earned by both the parent and the subsidiary. It should show the assets and liabilities of both the parent and the subsidiary. All right, I will not issue two sets of financial statements, one for the parent and the other for the subsidiary. I will be issuing one financial statements for which will include the assets, liabilities of the parent as well as the subsidiary, and the revenue and the expenses of the parent and the subsidiary. The only difference in head office, branch and parent subsidiary relationship is the legal form. In case of head office and branch, The branch is part of the same legal entity. All right. The branch is actually part of the same legal entity. SBI branch of Mumbai is part of the SBI legal entity. All right. Whereas in case of parent subsidiary, subsidiary is a separate legal entity. All right. Parent is a separate legal entity and a subsidiary is a separate legal entity. But you know that we as accounting professionals always give preference to substance over legal form. So are we worried about the legal form that the subsidiary is a separate legal entity? The answer is no. We're going to give respect to its substance. Substance being that just like how head office controls branch, a parent also controls its subsidiary, and we are required to produce one set of financial statements which includes the financial performance and the position for the parent as well as the subsidiary for the group as a whole. Before we get into consolidated financial statements, let's do a quick recap of what we actually used to do in the head office and branch accounts. All right, what you learned at your lower levels in head office and branch accounts, let's actually first do a quick recap of that. Here I've taken an example where the head office has a balance sheet whereby the assets are 10 lakhs, liabilities is 2 lakhs, equity is 12 lakhs, and in the head office balance sheet, this is just the head office standalone balance sheet, it has got something called as a branch account of 4 lakhs. Now this branch account, there are two ways of interpreting it. One, you can think of this as a receivable. All right, the head office has got a receivable from a branch of rupees 4 lakh. All right, that is one way of interpreting it. The second way of interpreting it is you can think of this as the head office investment in branch. All right, the head office has made an investment in branch to the total of 4 lakhs. All right, so there are two ways of interpreting it. One is you can look at it as a receivable from branch account of 4 lakh rupees. The other is where you can think of it as the head office has invested an amount in branch, which is 4 lakhs as of the balance sheet date. Now, throughout this discussion, I would be using the second interpretation, which is the investment that head office has got in branch. Now, just like how a head office has prepared its balance sheet, a branch would have also prepared its standalone balance sheet. Remember, these balance sheets are actually more for internal purpose. All right, the head office separate balance sheet and the branch separate balance sheet are being prepared only for internal purposes. We are not issuing these financial statements to the shareholders. All right. Similarly, a branch would have also prepared an internal balance sheet whereby a branch is going to have a corresponding 4 lakhs. All right. The head office was showing this 4 lakhs on the asset side. The branch is going to have 4 lakhs on the equity and liability side. Again, there are two interpretations for this. One interpretation is you can think of it as a payable to head office. You can think of this as a payable to head office. The second interpretation is this is the capital contributed by the head office. Just like over there, how we interpreted it as receivable and an investment, over here it can be interpreted as a payable or a capital contribution. Now I am going to interpret it as a capital contribution over here. Okay, in the branch balance sheet, the assets, let's say, are 5 lakhs. The branch has got a liabilities of 1 lakh. Remember, the branch would have maybe sold some goods. Therefore, it has got debtors of 5 lakhs. Assume that this to be debtors. Similarly, the branch would have purchased some goods. Therefore, it has got a liability of 1 lakh rupees. And this is the capital that has been contributed by the head office. Or you can, the other interpretation is that it is a payable by branch to its head office. Now, these are two books of accounts or two separate balance sheets that you have prepared more for internal purposes. You do not issue these separately to the shareholders. What you issue to the shareholders is basically a combined balance sheet. And to prepare a combined balance sheet, what we used to do was we used to actually pass journal entries. We used to pass journal entries in the books of head office. All right. We used to pass journal entries in the books of head office. What we used to do was we used to incorporate the branch assets and the branch liabilities into the head office accounts. All right. We used to follow a procedure called as incorporation of branch assets and liabilities into the head office books of accounts. All right. So in the head office books of accounts, there is a journal entry that we are going to post whereby we are going to debit branch assets. All right. I'm bringing in the branch assets into my books of accounts. So I debit it by 5 lakhs. I bring in the branch liabilities also in my books. So therefore I credit branch liabilities of 1 lakh. the investment in branch that I had, the investment in branch of 4 lakhs that I had, I am going to credit it. All right. I am going to credit it. So what I've done is I've removed that investment in branch, and instead of that, I've brought in the underlying assets and liabilities. All right. This 4 lakhs that I represented, that was represented in the head office balance sheet in one single row, I have actually now brought in the underlying assets and the underlying liabilities. And obviously this entry has to tally because the branch balance sheet is also tallying. This entry will also obviously have to tally. All right. And remember, this 4 lakh that I'm showing as an investment is exactly equal to what the branch is actually showing as its capital contribution. The 4 lakhs that the head office was actually showing as an investment is exactly matching with what the branch is actually showing as its contribution or equity that it has received from its head office. Now, after the head office posts this entry, then if the head office prepares the combined balance sheet, the combined or the consolidated head office balance sheet is going to look like this. It will have assets of 15 lakhs. How did it get an assets of 15 lakhs? It had its own assets of 10 lakhs, plus it brought in an assets of 5 lakhs that was actually belonging to the branch. All right, it brought in the assets of 5 lakhs that was belonging to the branch. Similarly, it will have liabilities of 3 lakhs. It had its own liabilities of 2 lakhs. The head office had its own liabilities of 2 lakhs. It then brought in, through this journal entry, it has then brought in 1 lakh rupees of liabilities, and therefore the liabilities is actually 3 lakhs. The equity remains as it is. There is no change in that. This equity represents the contribution that head office has received from its shareholders. The shareholders of head office would have contributed some money into the head office account. That is represented by this equity. The branch account of 4 lakhs, which was seen in the standalone balance sheet of head office, is no longer going to appear because we have incorporated assets of 5 lakhs and we have incorporated of liabilities of 1 lakh. Thereby, what has happened is what was actually shown as one single row called as branch account of 4 lakh rupees is now being incorporated line by line in assets and in liabilities. Remember, over here, I've just written one line called as assets, but there could be debtors, there could be inventory, there could be fixed assets. Similarly, on the liability side, there could be creditors, there could be borrowings, and so on and so forth. So I have incorporated line by line. I have incorporated line by line assets and liabilities of the branch, and I've removed that investment in branch that I had in one row. And this balance sheet is obviously tallying. 12 plus 3 is 15 lakhs. On the asset side also, I've got 15 lakhs. We are going to exactly apply the same principles in consolidated balance sheet in case of a parent subsidiary relationship. All that is going to happen is over here, instead of branch, you will have investment in subsidiary because the parent would have purchased investments in subsidiary. That cost might be 4 lakh rupees. Similarly, this will not be a branch balance sheet, but this will be a subsidiary balance sheet where subsidiary will have a share capital of 4 lakh rupees. And then we are not going to pass journal entries. We are actually not going to pass journal entries in our books of accounts, but you can imagine these to be as hypothetical journals. All right. We are not going to actually literally pass journal entries like what we did in case of a head office and branch, but these are the hypothetical entries that we are actually going to post, and then we will end up with a consolidated balance sheet of the group. All right, we will end up with a consolidated balance sheet of the group where I will not have any investment in subsidiary, but I will have the underlying assets and liabilities of the subsidiary in each row. All right, I will have inventory of the subsidiary combined with inventory of the parent. I will have debtors of the subsidiary combined with debtors of the parent. Liabilities of the subsidiary, individual liabilities of the subsidiary will be combined with the liabilities of the parent, and equity will obviously be equal to the equity of the parent. All right, the equity of the parent is nothing but the share capital that has been contributed by the shareholders of the parent entity. All right, P Limited, let's say P is the parent, S is the subsidiary. P Limited would also have received money from its parent. That is what we show in the equity section. All right, it's going to be exactly in the same way. However, there are going to be some advanced level of issues. All right, I'm not discussing or getting into those issues in this lecture. That's it for this lecture. All I wanted to drive home in this one is that the consolidation preparation of parent and subsidiary is exactly the same as that of holding, as that of the head office and the branch accounts. All right, that's it for this lecture, guys. Thank you so much. Bye bye.